So, yes, so I hope other colleagues are joining too. Is that Ananya? So it's nearly 3 o'clock. So Santosh, shall we wait for a couple of minutes for our two other panelists?
Yes, sir.
Okay. Okay. Good.
I think, sir, Mr. Gopal Krishna Tadas has joined.
Oh, okay. Oh, okay.
Yes.
Yeah, good afternoon.
Hello, good afternoon, Taras.
Are you able to hear me and see me?
Yes, yes. No, I am able to hear you, but not see you. Is your camera on?
Oh, let me check my. Okay. How is it now?
Very good. So,
Hello, sir.
Taras, very nice to see
Good
you.
afternoon. Yeah.
Good afternoon. Yes, excellent.
Right. Yeah.
Yes. So I think, and you are in Bangalore or?
No, actually, I came to my home, Dharwad.
Oh,
last 2 days I am here.
I see.
I'm going back tomorrow.
All right. All right.
Yeah.
Very nice to see you, and we are really looking forward to collaborating with you very actively. But before that collaboration starts, I thought let us have you on this workshop.
Yeah, definitely. Yeah. Thank you very much.
Thank you for joining. Thank you for joining. So, is Ananya on board already?
Yes,
Others
yes,
are
I
yet to
am.
join, I think, no?
Oh,
No,
okay.
I'm here, please. Yeah.
Okay, okay. So if everybody is on board, if there is some echo, I think, can you please mute yourself? Hello? Yeah, now the echo is gone. So friends, it is now time to start, and especially our three panelists have also joined. So I welcome all of you, especially our panelists, Mr. Gopal Krishna Tadas is an old friend, 40 years or 35 years old association. Although he's not old, but I mean, our association it goes back to 1985, 86. When he worked and both of us worked at RIS in those days in IIC Annex. Then Professor Rudra Sen Sharma, who is a professor at IIM Kozhikode, and our friend Professor Ananya Ghosh Dastidar at Delhi University South Campus. So with that, I think we are going to have a presentation first by one of my colleagues, Professor Santosh Das, and he is going to share with us some highlights of a very extensive work that he has done over the past year or so on NPAs in Indian banking sector. And this is, as we know, when we think of banks, this is the figure which comes to our mind, that the NPAs crisis is really very serious one, and they have numbers floated around. And this year, there are some estimates which I saw that NPAs could be of the order of 12 to 13%. I don't know, what exactly is the extent, but it seems to be a very high level of NPAs that our banks especially the public sector banks have accumulated. And this is a very serious issue because it affects their ability to lend further to facilitate the financing of industrial development, infrastructure development, and all other things, because finance is the key for everything. So Santosh has taken a very serious look at this issue and has come up with a number of findings which need to be debated and on the basis of which some policy suggestions can be made. So without any further ado, I want to ask my colleague Santosh to share his presentation, and then we will listen to our panelists, and then I will open it up for open discussion. So over to you, Santosh.
Thank you, sir. Thank you so much. Dhananjay, can I share my screen now?
Yeah.
So before I begin my presentation, I must thank our distinguished panelist who has kindly agreed to look at the report, and I certainly look forward to their comments and suggestions, which will be helpful to me for my future work and also improving the current sort of work that I am doing. And also, I must state that this project was funded by ICSSR, Indian Council of Social Science Research, under the NPAs scheme. And with their financial support, we have been able to complete this report. And also, I acknowledge the timely research support that I got from Khushbu Uppal. She has been working in this project as a project associate, and also Dibya Sharma, who worked briefly at the early stage of this report project. So with that, I will start my presentation. Uh, this report is basically, what I will do in this report is this report has tried to look at the sort of the NPA crisis of in the Indian banking sector for the time period between 2005 and onwards till 2020. And what I have tried to sort of look at is the major features of the current NPA crisis. How deep is the crisis? What are the major features from the side of the banks in terms of sources? Who are the major defaulters? And where is largely, you can say, the NPA is located. It has also looked into, tried to sort of explore empirically to what extent it has impacted the performance of the banks. And it has tried to look into the various factors those are responsible for NPA, or those might have caused NPA in the India's banking sector, with a focus on the factors which is specific to banks. Those are specific to banks and internal to banks and their operation. And also we have critically analyzed the current NPA management sort of framework, and we have suggested some based on our finding. So how effectively we can sort of address the NPAs. So this is the scheme of my presentation. Here, largely, I'll be looking at the major features of the NPA in context of the changing sort of banking landscape in India, where we'll be looking at the relative importance of the private banks is going up in terms of their operation, and the public sector banks operation has relatively gone down, though still they continues to the bankers for the country. And in the next section, we'll be looking at about the impact of NPA on banks, largely looking at the financial performance of the banks. Then I'll be discussing the various factors that is responsible, and here largely we'll be discussing about three critical factors which are internal to banks. One is their operational management. The second one is how they have managed their earnings. And the third one is the lending quality, the quality of their lending. So I've tried to sort of understand the NPA with those sort of on those parameters, how these factors have played and to what extent these factors have played important role in this current phase of NPA crisis. And also briefly, I'll summarize about the current sort of NPA management framework. What are the loopholes, to what extent it has succeeded in sort of addressing this crisis. And then we'll discuss about some policy suggestions that comes out from this report. And also towards the end, I'll basically try to, if I can sort of link the findings of the report, which are very specific to banks, if we can basically then build in a macro argument, larger argument in terms of banking policy, in terms of policies concerning financial sector. So these are some of the important, these are my scheme of presentation, and I must say, I must state why this study period has been chosen between 2005 and 2020 is largely because the uniformity in the definition of NPAs, that is number one. And also during this phase, the NPA crisis actually went off. There was some sort of upward surge immediately after the global financial crisis. Then after the asset quality review in 2015, then we saw the NPAs actually spiking up. And I must state the data and all the analysis that I have presented here, this is until March 2020. So now coming to the first segment of my presentation, which is largely looking at the changing banking landscape. Here I'll be looking at, the banking operations vis-a-vis sort of, banking, you can say, in terms of ownership, how the public sector's bank, or you can say the dominance of the public sector banks over time, how it has relatively declined, though they are very much needed at the moment even, and how over time, especially in the post-reform period, you will see that the operations of the private banks have gone up on major indicators. So here you can see in terms of these are, I've taken few indicators like number of offices, operating offices, functional offices, the asset share, the deposit share of the banks, and you can say the advances share. So on these four indicators, one thing that emerges is basically in the post-reform period, post-liberalization period, we see the emergence of private banks, and there has been a decline in the sort of in the operation of the public sector banks vis-a-vis the private bank. Though in absolute numbers, of course, on all indicators, even on the branches, assets, deposits, and on advances, the numbers have gone up. But when it comes to the composition, we'll find the private banks in recent years, they have grown on all indicators. And now coming to the NPA part, here we see, you can look at, as we saw, like on advances, like the public sector banks still disburse more than 65%, close to 65% of the total lendings in the Indian banking sector. When it comes to NPA, we see also, like if you see the sort of the graph here, we'll find there is a surge suddenly after 2015, which was the year of sort of the asset quality review. And here you'll find there was a huge surge in the numbers as far as the PSBs are concerned. And over time, the numbers have declined partly because of the capital infusion by the government in several PSBs. But one of the important aspect that we can note is basically over years like 2016-17 onwards, the private sector, the NPA of the private sector has also gone up. And at the moment, if you see the magnitude of NPA, at a time like in 2017-18, it reached more, it crossed beyond 10 lakh crore, which is a huge amount. And if you compare this volume to the earlier phase of crisis in the early 90s, where the total sort of NPA volume was about 70 crore, if I remember it, 70,000 crore, if I remember it correctly, in 2000, perhaps one in 2001 and 2. Now it is crossed, like in 2017 and 18, it crossed 10 lakh crore. At the moment, it's close to 9 lakh crore, which is a huge volume. That shows the sort of magnitude of the crisis in the Indian banks. And if you look at the sort of ownership bank group wise sort of GNPA volume in terms of, we'll find that the public sector banks are facing definitely a bigger crisis with close to 7 lakh crore sort of NPA. And if you look at the private banks in recent times, especially up to 2017-18, their NPA level volume has also gone up. Now it's more than 2 lakh crore, which is not a small amount in any way. And if you look at the share of the sort of NPA among these bank groups, we'll find about 75% of the NPAs is on account of the public sector banks, and 23% is on account of the private banks. So here what we see is basically one argument which was sort of, which was made again and again, which is the NPA is only in the public sector banks, not in private banks. That is perhaps not true given the recent figures, and we'll come to it at a later stage why sort of the NPA is higher in public sector banks and why it's relatively low in private banks, and why in recent times there has been surge in NPA in the private banks. And here you look at the GNP ratios of the PSBs. I mean, as you saw that the volume of NPA is huge, is huge in case of the PSBs. And if you look at the average sort of GNP ratio for the last 5 years between 2015 and 20, you will find, I mean, most of the public sector banks, the GNP ratio will be high. Like the Oriental Bank of, the Indian Overseas Bank has a GNP ratio of more than 20%. UCO Bank is close to 20, and IDBI Bank is about 17%. And there are other banks which are approaching 15 and between 10 and 15. So what it says is basically it demonstrates the sort of magnitude of crisis in the banking, in the PSBs in particular. And if you look at the leading sort of the GNP ratio of the leading private banks and leading foreign banks, here we see, the bank as a group, like private banks as a group, perhaps is they do not, I mean, it has a low GNP ratio, but though there are some banks with high GNP ratio, like the ICISI Bank in case of the private banks, and also like Standard Chartered Bank in case of the foreign banks, and you will find that, the higher GNP ratio in case of ICICI Bank is largely because of their exposure to industrial credit. I mean, not this period, but they used to, at some point in time, they have some exposure to industrial credit and also infrastructure credit, that I'll elaborate in detail at a later stage. So now coming to where the NPA is located in terms of sources, where it goes. I mean, what are the loans? Which sector are those sectors where the loan is getting NPAs, becoming NPAs? So there we'll find it's largely the non-priority sector. Though in case of public sector banks, we see during last 3 years the NPA in priority sector is also going up, but at the moment we'll find, when we discuss about the current phase of NPA up to 2015, you'll see that it's largely the non-priority sector which is responsible for which the NPA is happening is largely in the non-priority sector, and that is also true for the private banks, where you'll find more than 80% of the NPAs are located in the non-priority sector. Now coming to what is the characteristic of the loan in terms of size, or who are these sort of borrowers who are defaulting? You will find one aspect which is, I mean, this is basically one of the dominant feature of the post liberalization, you can say, banking sort of lending structure, where you'll find over time the lending is getting consolidated in favor of the large loans. And that is also seen here. You will find more than 50% of the loans are disbursed in the banking sector, by the banking sector, are large loans, and out of which about close to 3/4 of about 75% of the loans have become NPA. So it's largely the large loans, or the defaults, large loans which are responsible for NPA, and it's largely the corporate sector which is defaulting, and they are the one who access credit in the form of large loans. If you look at the sectors wise sort of analysis here, you can see it's largely the industrial sector where the NPA is more. Like in 2018, the NPA was close to 21%, which is reduced a bit. Which reduced a bit in 2019 and declined substantially in 2020. But still, as per the recent data, it's close to it's more than 12%. And another important sort of feature we see is basically over time the NPAs in the services sector and also in the agriculture sector is going up, but predominantly it's largely the failures or the defaults in the industrial sector which is responsible for this current sort of NPA crisis. Now, looking at the subsector-wise analysis, here you will find it's largely the infrastructure sector. I have just provided data for the recent year, which is on March 2020. So here you will see basically more than 37% of the sort of credit, bank credit, goes to the infrastructure sector, and there you find about 12% of the that loan has turned into NPA. So here you see it's largely the the infrastructure sector. There's a high NPA in food processing. There is high NPA in basic metals and their products. There is high NPA in textile sector. So these are the sectors where NPAs largely have located and loan failures have taken place. Now, these are just like what I explained is basically the broad features, the key features of the current NPA crisis. Though in the report, I have also provided a brief sort of a comparative analysis of the NPA crisis of the 90s, though it's very brief. So what we can basically, if we draw a parallel between the two episodes, we'll find the one thing is very important, which is the magnitude of the crisis is very severe. As I said, it's more than 10 lakh, close to 10 lakh crore, which is not a small sort of amount, and with 2 lakh crore sort of NPA in the private sector. And also, like most of the loans, those have turned into NPA are located in the non-priority sector. But in the earlier phase, priority sector was also equally hit. So those are the major differences. And the major difference is NPA and how do you manage that? Because when you have a 7,000 crore sort of NPA, then it's the kind of sort of policy response that is required to deal with that would definitely differ from the fact that you have more than 10 lakh crore NPA, which is much higher, much higher. Now coming to the performance of the how it has impacted the banks in terms of performance. So typically, NPA in a bank can impact in two ways. One is basically when NPA happens, then what happens? The interest income goes down because you are not earning on your lending. Then that impacts your profitability. The interest income goes down, and that impacts the profitability. The other aspect is which is when when the bank fails to sort of recover its principal amount, then what happens is the banks the capital of the bank gets reduced, and that is one of the sort of it's very critical for the bank in terms of its stability. So but the combination of the two might pose an serious sort of the bank might face serious concerns on account of these two, and they may become insolvent in the longer run. But these are the two important things. This is how the NPA impacts the bank. What we have done here is basically that is quite reflective on these parameters. If you look at the profitability of the banks as measured on ROA, which is return on asset and return on equity, and also if you see their interest income, you will find on all indicators it has declined, post 2015, and that is true for PSBs and private bank. Though the profit, the rate of profit, like in case of PSBs, the return on assets is negative. That is not true for the private sector banks. So in profitability, private sector banks are doing relatively much better than the PSBs. But the similarity is that both of the bank groups have seen decline in their profitability rate. So I've tried to analyze how NPA impacts the profitability of the banks, as that is the sort of performance measure. Though we can debate whether the profitability should be the sole criteria to sort of analyze the performance of the PSBs, that can be debated. But but assuming that is the criteria, which is the case is at the moment, then how the NPAs have impacted the profitability of the banks. The result shows that it has impacted negatively, and it has reduced the sort of, you can say, it has impacted the profitability of the banks. Now, in the next section, what I've done is basically I have estimated the determinants of NPA, and I'll straight go to the discussion section. So basically, the literature suggests there can be various factors which can be responsible, be responsible for NPA. So there could be, broadly, you can divide this into two sort of set of factors. One set could be factors which are internal to the banks and internal to their operation. The other set could be the sort of the factors which are external to the banks, like the macroeconomic factors, the regulatory aspects, issues with the borrowers. There are certain industry specific factors which can also lead to NPAs. So what I have done in this report is basically I have, in terms of literature, I have tried to look, analyze, what are the major factors. So we have provided the review of mostly all the, all the broad factors, but empirically we have sort of examined to what are the major sort of bank specific factors which have played important role, because one of my major sort of concern was to assess the credit model of the public sector banks. If the NPAs can be explained with this sort of analysis, is there any major difference in terms of the credit model between the private sector banks and the public sector banks, which actually which can potentially explain the differences in NPAs. So with the estimation, what we found is basically, as I said in the beginning, we took three broad sort of set of indicators. One is the operational management, which is reflected in operating cost. Another one is the earning management, which is reflected in ROA and on interest earning. And the third one is basically the quality of lending. So here we have taken, two major indicators, which is basically the secure loans. Share of secure loans is percent of total lending, and loans to the sensitive sector, like real estate and other sensitive sectors. So what we found is basically the findings are very interesting. One of the aspect that what we found is in the current phase of NPA, that is true for all bank groups and all time period. That is basically for, you can say, the whole time period, and also for the period in the post sort of financial crisis. You will find, operational operating cost, as you say, like in many, we see, largely in the debate or discussion concerning banking, and this has been given one of the pretexts or one of the context for privatization of the public sector banks, that there are a lot of operational inefficiency which has resulted in NPA, and they're not able to perform. But if you look at the results, it suggests it's not the operational inefficiency which has resulted in NPA, which has contributed to the current phase of NPA. This is largely the issues in earning management and the issues in sort of quality of lending. And when we look at the quality of lending, there we see, the finding is very interesting. Like we see there is a positive relationship, and the relationship is statistically significant between the NPA and between the NPA and the share of secure loans. Literature suggests usually if a loan is backed by a collateral, then the probability of loan default or credit risk is minimum, it goes down. So ideally the relation should be inverse, but in this case we found this has actually contributed. And the catch here is basically, if you see, which is also is there very much in the public discourse in newspapers, and other debates, policy debates, where you see, though like I think many sort of lending, or you can say projects which are backed by assets, collaterals. But what happens is basically the valuation of the assets is largely linked to the performance of the asset market. So when there is, especially in a downturn, when the asset market is not doing good, the economic outlook is not good, then the valuation of the asset goes down because it's related to market. So when the market value goes down, then at times what happens is basically the value of the collateral is much lower than the value of the loan that the person or the borrower or the company or the individual is supposed to pay back. And that has actually contributed a lot in this sort of NPA crisis. And also the earning management, like, to maximize profit, as I said in the beginning, when the maximizing profit is the sort of, assessment, or the assessment on which the banks are assessed, their performance is assessed. So in the, trying to sort of maximize their profit and earnings, they've undertaken risky lendings. So these are the two important factors which have contributed to current sort of phase of NPA. Now, as I said, these two are very critical, earning management and quality of lending, and both are also closely related. Like in a bank, which is largely intermediary based, they own their they own from lending. I mean, they collect deposits and use that in the form of lending, and the margin that take is their interest income, and that is how, a bank grows, a bank performs. But you'll find basically what in this section I'm trying to do is I'm trying to look at the differences in the credit approach of the public sector banks and the private sector banks, and if that can explain, because in the regression what this suggests basically there is some, I mean, this the quality of lending which has contributed, and here we are trying to look into in detail I mean, where is the difference in terms of lending behavior. And first I'll give you a macro picture about the lending of the bank lending, and here you will find basically where the actually bank credit goes. Bank credit goes to very few sectors, the concentrated in very few sectors. One was NBFCs, which is another issue. Like NBFCs are also facing crisis, and and it's larger the public sector banks. Those have huge exposure, considerable amount of exposure in NBFCs, which yet to come. I mean, that will be if the NBFC crisis in NBFC goes, then the banks are likely to face further crisis, in future. And infrastructure sector is another sort of this sector where you will find bulk of the bank credit going, and another sector is basic metal and metal products. So if you look at the current figure, which is recent data for 2020, you'll find these four sectors, which is basically infrastructure, NBFC, then basic metal and metal products, and textile. These four sectors constitute about more than 80% of the total bank lending. So this is how this is what the structure of the lending, the bank lending. And if you look at the industry-wide growth of bank credit, you will find these are the sectors who received sort of significant volume of bank credit. And during early time, you see you have provided data from 2006 onwards. You'll find between 2006 and till 11, 12, you'll find 13 also, you'll find there have been huge growth of bank credit to these sectors. And subsequently, with the asset quality review, when the NPA figures came out and a lot of projects were classified as NPA, then the banks sort of stopped lending to these sectors. That is reflected in the data. So then the point is, what is the differences, and how can we explain the NPA in private banks and in public sector banks in terms of lending? So here you can see the exposure, or you can say is the exposure of the public sector banks and the private banks when it comes to term lending to medium and large scale industries, and also lending to the infrastructure sector. In the left side, the table is for lending to medium and large scale industries. The right side is lending to infrastructure sector. So here you will find the most of the public sector's bank, their exposure to industrial lending is substantially high. There are banks like IDBI Bank, more than 50%. State Bank is close to 45%. Andhra Bank 42%. Bank of India close to 45%. And so what it basically says is, and Visa Bank, it is a small bank, has an exposure of more than 60% in 2018. But you look at the private banks at the bottom. I have just provided data for few leading private sector banks, not all, because most of the private sector banks, small banks, they do not lend large projects. So you will find, Axis Bank had some exposure close to 30%. ICICI Bank, as I said, it has once upon a time it used to lend to industry heavily, so it has still some exposure. But when it comes to SDFC Bank, this is the second largest bank in India after SBI. Look at their exposure; it's basically close to 25%. And like IndusInd, Kotak Mahindra, all are less than 30%. So what the difference we can see is the public sector banks largely lend to the industrial projects. And if you look at the lending to infrastructure project, here you will find like substantial exposure. For instance, SBI's lending to infrastructure sector is more than 20%. UCO Bank more than 20%. United Bank of India more than 25%. Central Bank close to 24%. So the exposure of the public sector banks is huge when it comes to term lending, or lending industrial credit, industrial sector, lending to the infrastructure sector. But when it comes to the private bank, you will find like SDFC Bank has no exposure when it comes to infrastructure lending. Only these two leading banks like ICICI and Axis Bank, they have some exposure in infrastructure lending. The rest of the private sector banks do not lend to infrastructure sector. So that is the major difference between these two, which partly explains the NPA crisis. And the third, another aspect, if you look at then which is another interesting feature here. In the left side, you see the share of personal loans in total lending. So I have given a comparative picture of like the PSBs where do the lend, how much they lend to the personal finance personal loans, and how much the private banks finance personal loans. So here you can see, when it comes to financing personal loans, the PSB share is relatively low vis-a-vis the share of the private sector, like Axis Bank more than 31%, SDFC 26, ICICI is 30%. So the dominant feature, if you look at in terms of sort of credit approach, as public sector banks, what is their approach to lending, and as private banks, what is their approach to lending? So we'll find that the public sector banks has significant sort of, you can say, considerable exposure in industrial lending and also in infrastructure lending, which have a different characteristic that we'll be discussing towards the end of the report when we discuss about the recommendations. But that is the difference. In private sector banks tend to focus more on personal loans. There are some figures which I'm not reporting here, but it's there partly with the report and with me, which will be used per paper. We'll find there is an interesting phenomena which is happening here. Is basically, in case of private banks, you'll find there are a lot of disintermediation is happening. Like the banks are relying more and more on good as far as intermediation goes, because the prime objective of the bank is to intermediate, like you collect deposits and you lend to the wherever it's needed. Now what is happening is basically in many of the private sector banks, will find they have started relying heavily. First, they are risk averse, they do not lend to risky projects. Second, they have started relying more and more on interest earning sort of sources, which is basically you invest in other financial institutions for that matter. You invest in other financial products which will give you higher earnings. So these are the major differences when it comes to approach to earning and approach to lending. So, and the next section, what I will do is basically I have looked at the whole story of willful default. As we know, there are a lot of, and willful default is largely, you can say, the misuse of fund. The funds were borrowed for with a specific purpose, but they were either diverted or misused. So this is largely the willful default. So I have sort of estimated the willful default, taken the data for the two categories. As TransUnion Civil provides data for two categories. One is for default of rupees 25 lakhs and above, another is for default of rupees 1 lakh crore and above. So I'm just reporting here to save time with just one category. The other category is very much similar to that. You will find in post 2015, the number of sort of willful defaults have gone up with the asset quality review. It must have been, I mean, the process must have started much earlier, but it came up after the review. And when you look at the volume, that is also true. The volume also went off up to 2015, and largely what the willful default suggests basically, there is considerable sort of amount of space for collusion between the borrowers and the banks to sort of to divert fund or to misuse the fund. So there is some nexus which actually results in willful default. So about this also will be discussing towards the end of this report. And if you look at the number of cases bank wise, I have just looked at the individual bank wise, the willful default. So we'll find State Bank of India is the highest sort of percentage share among the public sector banks, highest share, close to 26% of the total willful default of this category, which is rupees 5 lakhs and above. And when it comes to the volume, it's more than 23%. So one aspect is there is there has been substantial rise in the public sector, in the willful default in the banking sector as a whole, and in the public sector banks in particular. And the other side is basically if you look at the corporate performance, as we've seen, there has been high NPA in the corporate sector, in the industrial sector. So one feature is funds are being misused, which is reflected in willful default. The another feature is there is high NPA borrowed by these corporates. And if you look at the performance to analyze whether these are sort of, it might have been like, the defaults is arising out of genuine concerns, like their performance have really declined over time. And as the economic survey in 2016-17 sort of, try to picture it, sort of analyze in a way the twin crisis, it says how the weak corporate balance sheet is going to erode the bank's balance sheet, in a way suggesting basically, is the weak corporate performance which is responsible for NPAs, the weak balance sheet of the banks. So that is something I think is highly questionable, because if you look at the NPA data, I have provided it for data for 5 years. Even if you also can go back till 2010, you will find, first the banks are not the companies are not over leveraged. There are issues with very few sectors, subsectors, one or two, where you can find high debt to equity ratio, but that is not true for most of the sort of, subsectors or sectors. That's number one. Number two, if you look at the interest coverage ratio, which is basically whether a company is earning enough to cover or pay back its interest, you will find basically, leaving one or two sort of subsectors, most of the sectors, I'm providing macro data, maybe in some sort of sectors where companies are genuinely not earning, but I'm sort of trying to build a story here, trying to say that most of the, if you look at the macro data, it suggests that, companies or the sectors are doing good relatively. They are at least able to pay back their, solve their debt, which they are not doing, and they are not highly leveraged. And the third component is there is willful default, which suggests that widespread misuse of funds. So the combination of all these suggests that basically there is this element of cronyism, which is actually also responsible for the current sort of, current crisis in the Indian banks. So this is how I have summarized. I am not here presenting about the initiatives taken by the Reserve Bank, the government, and through legal measures to sort of, contain NPA, to reduce NPA. And one of them, the recent one is IBC, Insolvency and Bankruptcy Code. And so there are several other sort of initiatives by the Reserve Bank, by the government, by, at different levels, to basically address the NPA issue. But more or less, it has not been that effective. I'm not, due to lack of time, I'm not going into that detail. But what I must say is basically, when I discuss about, the NPA management and resolution approach, how it should be, I think based on the report, what I can say is basically we can segregate the NPA issue into two. One is basically, how do you address this issue of NPA? How do you sort of the set of policy that is required to sort of contain it in future, to reduce it in future, to prevent, it happening over time. And another set is basically, you have certain accumulated NPA, how to do that, how to resolve that. We have already about 10 lakh crore sort of accumulated NPA, what to do that. So basically, what the report suggests is basically any NPA mechanism or resolution mechanism or framework must address these two keys, and these two aspects or elements should be built into the policy sort of, spectrum, where, a set of policy is being sort of suggested, which is addressing both these issues. And if you look at the current sort of structure or the approach to policy, it is largely it's about what to do with the existing NPA, basically how to reduce it, like IBCs there. You create an AMC, then AMCs are being created, then you sell, the bank sells those assets to AMCs and they recover some. But also we see how the banks are losing, like the recent data, even if yesterday's recent figure suggests the resolutions that is taken place through IBC, the recovery rate is 40%. So out of 100 rupees, if the default is of 100 rupees, then the lenders, the banks, have been able to recover only 40% of it, which is very less in a way. So you can say that the focus is basically largely, what to do with the existing NPA. But I think this is important also to look at, or to sort of develop a set of policy, or as a framework of sort of a policy mechanism, which should be looking at how to, to prevent it in future to happening in this sort of, massive scale. And to do address that, we need reform. You can say we need policies which are structural in nature. So we have to address those policies policies in a way so that the NPA doesn't happen in the long run. In over time. And one important feature that we could gather from our sort of review of how other countries have tried to address the NPA crisis, countries in the East Asia, like China and other European countries, in US also. So you'll find one common element, commonality among the countries is basically in all when it comes to NPA resolution, addressing the crisis in banking sector and also in the financial sector, it's largely the government who takes the initiative for various reasons. And in India, being a being a bank-based sort of financial system, and where the PSBs play a dominant role, and the government being the owner of the banks, the role of the government becomes even far more important when it comes to developing a NPA sort of resolution and management framework. So what the report recommends is basically there are four key suggestions that emerges from the trend, the trend of the NPA analysis, we saw basically up to 2015 the number of NPAs went up with the asset quality review. So what it suggests is basically at one level there is not much of project appraisal happening. This is also related to the issue of lending quality. So the risk has to be assessed assessed in a way that the banks are able to actually identify the potential future risks of any particular project. And the three is largely related to the loan administration, which is basically monitoring, accounting and auditing. During the asset quality review, you will find a lot of loan NPAs actually have happened earlier, but it was uncovered in 2015. So what it suggests, basically, there was no effective monitoring, there was no proper accounting, and there was no auditing. And if you look at the RBI circulars to the banks, it's interesting to note, in a gap of 2 years, 3 years, you'll find the same circular is being sent to the banks, suggesting the banks while auditing, while sort of documenting or while preparing data, their balance sheet, they should adhere to the norms of the Reserve Bank. This is very interesting. The one sort of intuition is maybe the banks were not following. That's why it comes again and again to the banks that you adhere to the norms, how to classify a loan account, whether it's NPA or whether it's willful default and all. So that is something I found very interesting, because I find, like, for instance, about the willful default, I found 4 or 5 circulars from the Reserve Bank with similar content, and they're referring back to the earlier one referring to the earlier one. So what I'm saying is there are guidelines, there are circulars, but it's not adhered to. So the banks basically look, strictly follow, appraise their project. They should monitor it effectively, so that the collusion doesn't happen between the bank officials and the corporate officials as such. And accounting is something it should be followed. I mean, the banks should follow basically the accounting norms of the RBI, which has been sort of issued by the RBI. And there is also the auditing, basically, which basically the end point where the loan is classified, whether it's a willful default or final loss account. There are different categories of sort of NPA account also. Now look, now there are some other sort of suggestions that comes out of the report. Is basically the banks should revamp their credit model, and especially the public sector banks. It's only because, as we saw, the lending quality is very important. Earlier, the banks have heavily relied on collaterals. As we saw, the collaterals are, even though banks, a lot of loans are which have turned into NPA were backed by collaterals. But since they are linked to asset market, when the time asset market is not doing well, then the value of the collateral goes down, and the loan turns into NPA. So the banks should factor into this aspect as well while they sort of revamp their credit model. This is very important, given that, and it's very important for the large projects, because the volume of sort of lending is really high. And then the other two is basically strengthening the governance of the banks, and we should look at the corporate governance practices. These two are very important. Why? Because we see at one level the willful default is going up, the other level, despite having relatively better performance, the banks, the corporate sector is not paying back or serving its debt. So to one level, it suggests there is some amount of collusion that exists in the system that needs to be addressed from both the sides. From the side of the bank, their governance needs to be strengthened. From the side of the corporate sector, so that the officers of the corporate, of any corporate, is not able to sort of manipulate the system and misuse the fund. So this is very important uh, from the point of view of NPA, preventing NPA. Now the another recommendation is basically monitoring large projects. Either there can be separate agency. This can be true for, for especially for public sector banks, because they are the one who tend to lend to large projects, and there can be an agency which will monitor basically if the banks are not able to do, given that they have limited sort of capacity when it comes to appraising technical project and monitoring technical projects. So that can be also a separate agency, can be public agency, funded agency can be sort of created, which will look into the large projects, and they can also develop a set of lead indicators. We have like lead indicators which will are performing, and that can be periodically assessed. So this can be one of the sort of this can be very effective when it comes to preventing or turning large projects into NPA. Now another is basically greater supervision and regulation. So there are a lot of issues when it comes to, like, this has been aired by different governors and deputy governors in different speeches and all, which is basically to what extent the regulator can be effective in terms of the issue of ownership, the issue of who can appoint, the issue of independent director, the issue of how do you sort of take actions, like the private sector's banks are registered under the Companies Act, the banks are under the Banking Sector Act. So there are a lot of legal issues which they have been keeping, sort of referring to, which is actually have constrained the Reserve Bank and actually streamlining a lot of regulatory and supervisory activities. So that needs to be looked into. And another which is very important, is we saw that the large loans dominated the banking when it comes to lending by the PSBs. And here we see they have they have given loan heavily to the industrial sector, to the infrastructure sector, and these banks do not have adequate expertise, technical expertise, to deal with that. And in the absence of that, what they tend to rely more in, like, you have a consortium system where, like, some big banks or some big banks, they assess a project, and the smaller banks, if they are collaborating, they also go with that assessment of the big banks. So first, they have in-house not inadequate in-house capacity to deal with these high value technical projects. And the second one is, often they rely on these rating agencies to assess a particular project. So the problem with the rating agencies, basically, see, these rating agencies, they basically survive on the money that they receive from their clients. So there is conflict of interest. For instance, company A goes to a rating agency to get the company assessed, which will be used for lending by another bank. What happens is, since the rating agency, their income, their growth is dependent on these clients, which in this case, which are the private banks. So what happens is, basically, they tend to overlook certain risks, which is a risk for the banks. But the way it's basically suggested, the way it's analyzed, the banks are not able to sort of find it out or figure it out at the time of lending, so which creates problem in future. So for that reason, the banks should not lend in the term lending, should not do term lending. That can be done by the DFIs, which we had a system in the past where DFIs used to lend to the industrial sector, or used to lend large sort of projects, given their expertise. Like, there was also sector specific DFIs in India at different times, especially after the post-independent period, till 90s, till the reform initiated. Still, a few DFIs like SIDB, NABARD, they are still operating, but the scale and their sort of the degree of their intervention in the sort of financial sector has has been considerably reduced. So another aspect is important recommendations. Basically, we need to develop our corporate bond market. Actually, this was envisaged at the time of reform, when the reform was carried out in the financial sector and the banking sector, that the banks will basically disburse the working loans and with closing down or converting the DFIs into sort of commercial banks. For term lending, the companies will raise money in the corporate, from the corporate bond market. So that was envisaged, and that actually didn't happen. If you look at the size of the sort of corporate bond market in India today, its size is very small. And even if you compare it with similar economies like Brazil, Argentina, even with China has a massive sort of corporate bond market. So we have a very small bond market. The size of the bond market is corporate bond market is very small. So we need to strengthen that, which will be a source of lending for source of finance for the corporate sector. And to at the end, I must say that we need an institution similar to bad bank when it comes to resolving the existing NPA. We have an existing NPA of about 7 lakh crore in the PSPs. So how do you sort of resolve it? So some can be resolved through restructuring. Some loans can be sort of which is might turn into NPA. Some loans can be revived through different ways, but the loans which have been already sort of declared as loss account cannot be revived. So they need to be dealt with. We have to create an institution who will deal with that. So in the report, I have elaborated. It's a bad bank which actually happened in Sweden for the first time in 90s. It's a kind of AMC with specific features, where the target was basically, how do you maximize your sort of maximize your you can say the lendings. How do you maximize recovery with minimum cost? And it has certain peculiar feature, so that has been clear, detailed out in the report. Not unlike the AMCs that we are sort of witnessing. The difference between the Swedish model and the current model is basically, even though Swedish model is also another a form of AMC, what they did is basically, first, it was owned by the government. Second, they basically procured all the bad loans or the failed loans from the banks, and they hold it till the asset market started doing well and the economy was doing well, so that it can be sold at a better price. That ensured the maximum recovery. And it was purely, though it was managed by private individuals, people from also private financial institutions were hired sort of to manage it. But essentially, it was a public funded institution which protected the public money. Because the Swedish banking system was largely a public sector one, and since it was largely the government money which was involved, so they adopted this strategy to maximize the recovery. So that is something we can also try here. So that is the suggestion. How do you sort of address that? Now, coming towards end, as I said in my beginning sort of remark, with this finding, what can we conclude for the larger story? How can we sort of intervene? How can we get into the larger macro debate with respect to banking sector policies? So one is basically, we should be assessing critically what has happened to financial sort of reforms or liberalization, as we say, because one of the critical sort of discourse, I mean, this was the discourse, the pretext on with which you can say the reform was initiated, that it will definitely it will bring in allocative efficiency. That clearly didn't happen. It's not happening at the moment. It didn't happen. And so this is something which we need to look at, the whole sort of liberalization discourse. In fact, if you look at the experience of India, we find the period of bank nationalization actually did much better than the period of liberalization when it comes to intermediation, collecting saving and disbursing loans, and also addressing the national sort of development priorities. Now I'm just commenting, these are very important with the current approach. Basically, the three instruments which we often see in the public discourse with respect to banking sector policies today. One is basically the merger happened, though it was recommended by Narasimhan committee. Now there is sort of renewed sort of interest.
Santosh, can you wrap up quickly, because we have to listen to the
Yes, sir.
experts. Yeah.
Yes, sorry. So basically, whether the merging can address this issue, whether the IBC recently this enacted sort of code can help us reducing the NPA, or whether privatization can address this issue, which is now often seen as one of the solution to this crisis in banking. So these are the some of the issues that we can probably enter into with this finding. So which I am already doing in the form of papers and all, but this is not part of the report, the last section which I'm on the screen. But these are some of the findings which can be sort of related to this report. Thank you so much.
Thank you, Santosh, for giving a very comprehensive overview of the work that you have done as a part of this project. I think there are a number of interesting findings, including the fact that NPAs are not largely because of the, priority sector lending. So the social objectives are not leading to the NPAs. That is, I think, very important to know. And then the collateral-free loans are also not causing the NPAs. That is another interesting finding to know. The fact that PSBs, public sector banks, are the ones who are lending to industry and infrastructure, and they are getting into the NPAs. So it is not absolving private sector banks from that they are managing their assets better. It is not like this. They are not even lending to the industry and infrastructure. So obviously they are better off. And then this willful defaults is really something happening. So now the question comes whether the commercial banks are really equipped to do term lending, which they are doing, and they are getting into the mess that they are. But I think so. Some very interesting findings and recommendations are there in the report. So I want to now turn to our three panelists before I open it up. And so let me turn to Mr. Gopal Krishna Tadas, who used to be an executive director in IDBI of the time, when it was really a term lending institution. And so he has, as a practitioner, I think he can reflect on some of your findings. And then I will go to the two academics who have been invited to comment upon it. So, Taras, you have the floor. Hello? Is Gopal Krishna Taras, are you there?
You're on mute, sir.
Oh, so can you unmute yourself?
Yeah, unmuted. Is it
Okay,
okay now?
Yeah, perfect.
Yeah, right.
Go ahead, please.
Yeah, thank you, Dr. Nagesh, for the invitation to be part of this panel discussion. It's a topical subject, and the NPAs crisis has been very critical, not only for the banks but for the government and the economy as a whole. So in that sense, I think the study done by Dr. Das, we should compliment him. It's comprehensive and exhaustive, and he has covered a very critical issue of the banking system. The study being very large and covered many issues. Given the time, I would like to focus on a few areas, and then maybe I will send across my comments if they are useful to you. Because there are other panel speakers who also like to come in subsequently. On the landscape which you have covered, I think that's basically setting the basis, the framework to deal with the NPA situation. So that sense, I thought, yes, you have covered the network, the branch, expansion, and then the services, the delivery, and all those issues. But if you look at the way the branch, the bank's network has improved or expanded, I think we can clearly distinguish in three distinct phases. One is, of course, the starting from the nationalization itself in 1969, which you can say as basically government taking recourse to bank-based or supply leading approach, as you can see in the finance literature of Mackin and Shaw or Patrick and so many other people. Now, I think that set the framework for the public sector banks. So many banks were nationalized with the objective that the banking services should reach the remote parts of the country and the weaker sections of the society. Now, of course, with this decision, the branch network expanded significantly, and the services were now accessible to those to whom hitherto they were not available. But then in the process, it also created a multiplicity of branches within, for instance, small town. Now, if in a small town or a village, one branch or two branches can serve the population, what is the point in having so many banks? I'm talking basically of the public sector banks, having their branches and then competing amongst themselves. So this also in the process led to kind of duplication of the banking activity in an uneconomic, unviable way, I would say. And then in the process, it also affected the services, although it increased competition. But then the government banks competing amongst themselves, I don't think would carry much of a meaning unless the service improves. The service did not improve. So there was a deterioration in the quality of the services. And then it also led to some kind of imprudent lending because all of them had to lend somehow. So they lent. So it was kind of imprudent lending. So you can see that, although, yes, the desirable impact was there in terms of accessibility, but there were also undesirable consequences. Now, if you analyze the results in terms of efficiency, in terms of operating costs, in terms of service delivery, in terms of the productivity or the profitability, you will find that they have taken a beating maybe over a period of, let us say, for 1969 for the starting point. At the end of 80s, you find that there was a deterioration in these aspects. Now, subsequently, towards the end of the 80s or beginning of 90s, we had a second phase where the financial liberalization was initiated. Then, the government allowed setting up of private banks, and private banks entered. You also mentioned that in the two phases of NPAs which we evaluated, the private banks had more NPAs in the 90s than currently. Now, this is also one of the reasons, private banks were new to the banking then. And, they had to, having entered, and it was basically dominated by the public sector banks and other bigger banks and the development finance institution. But then, in order to see that they also do some significant business, the only way they can speed up their business is by lending to large corporates. So they did a lot of corporate lending in the 90s, which in fact should have been the other way around. They should have started with the retail lending and then gone over to corporate lending. But they also wanted to be bigger in the process. So they started lending to the corporates without having systems, procedures, and risk management in place. Because they were to learn, they were to set up, all these would take time. But then I think they were in a hurry to show that they were also contributing and they were also increasing their business. I think this is what led to the increase in the NPAs of the private sector banks in the corporate sector, especially in the late 90s. I think, they have learned the lessons and then over period, you see that the composition of their portfolio, business portfolio has changed. They more over to the retail banking, the personal banking, and in the retail banking, more of a SME and things like that. And they also improved their systems and procedures. and the risk management aspects, which took care of the quality of lending, and then they mitigated the risks. It's not that they were averse to risk. In fact, you can see the 90s showed that they were not averse to risk. But then, they were not familiar with the aspect of lending then. But then, they changed the composition of their lending. They were, taking risk, but they were taking the risk mainly in the retail portfolio. So you are diversifying risk. So earlier there was a risk concentration, whereas now there is a risk diversification by lending to large, number of retail clients. So this is the, structural change that happened in the private sector, which unfortunately did not happen in the case of public sector banks. Now, there was a time, when in the till I would say the 2000, 70s, 80s, and 1990s, you had separate, set of banks dealing with large projects, corporates. You had the development finance institutions, whether it is IDBI or IFCI or ICICI, and quite a few, the NBFCs, big NBFCs then. And then, there was a time when, these banks, DFIs, used to appraise the projects, and they used to give only the term loan. And then, the commercial banks, the public sector banks, so-called, they used to give working capital lending to these projects which were assessed by the development finance institution. So there was a kind of complementarity in the activity of the development finance institutions and the activities of the commercial banks, which unfortunately totally, was phased out after the liberalization, especially after 2000, I would say. The IDBI was converted into a commercial bank. ICICI also got converted into commercial bank. And then the new set of DFIs, were set up, whether it is IDFC or NIF in the recent years. But, they could not contribute significant, lending to the infrastructure or the industrial sector. So there was a kind of an overlapping of the role of the DFIs and the commercial banks in the late 1990s and subsequently. They were doing both term lending as also working capital, as also the retail lending. Now, if you were talking about, the expertise, the technical expertise required to appraise projects and all, in the IDBI, in ICICI and IFCI, you had technical people only. There were people, with the engineering background, with project background, and they were doing a project appraisal, and there were, the independent engineers, independent agencies who were appointed to monitor the projects. That was, clearly defined role for these DFIs. And then they were never doing any banking. In fact, their accounts were with the commercial banks. IDBI account was with other commercial banks, and we were not taking deposits from the public. So, but the liberalization, yes, has its own consequences. Desirable, undesirable, yes, only the time would say. And yes, some extent it has been undesirable, some extent been desirable. But from the system of bank-based, we have now switched over to a combination of both bank-based and the market-based. Now, whether as a developing economy we can afford that kind of a system, or whether there is a need to have a separate set of banks, the development banks, which deal with the industry, which deal with infrastructure, and which deal with the technical aspects of appraising the projects. And then you have the public sector banks, which can take care of the day-to-day requirements of these corporates and the retail lending. Of course, there are private sector banks who would, yes, not be taking a big exposure to the infrastructure projects or the industrial projects. So they would definitely be competing in the area of the retail lending. So I don't think we can call that as risk averse, because that is the model they will be adopting, because ultimately capital is costly. And we talk of allocative efficiency. Now, if there is a concentration of risk, then your portfolio suffers, Although you may say from the risk return point of view, lending to corporate would have been better, but when they become NPA, you will find that it would be a toughest service situation. So there are difficulties. So they have learned in the process, that's why you see that there is a shift in the late 90s to the recent years in the portfolio composition of the private sector lending. And I think, they are taking calculated, risk, and they are doing a very calculated business. And I think, that is what is expected of them as a private bank. So I don't think we can call it as a risk averse. But then, we need specialized banks which can understand the risks, which can, appraise the risks and the issues involved. And then, these have to be complemented by the consistent and the compatible policy framework by the government. Now, why is that so many infrastructure projects suffered? It is not because there was kind of an imprudent, appraisal or imprudent lending by the development finance institutions or the banks. It is because, the combination of, yes, I would say, somewhat imprudent appraisal plus the policy aspect. Because, you see the power sector projects or even the coal-based, the projects, all of them suffered not because of the appraisal aspects, but because of the policy issues. So I think, when we talk of NPA, it is not just, sufficient that we talk of the failure of the banks, but also we should be talking about failure of the government in seeing to it that there were compatible policies which were consistent, would be consistent with the nurturing of these large projects, whether it is in the infrastructure or in the industrial sector. So I think, if we analyze the NPA either in terms of the phases, 1990s and subsequently, or in terms of the determinants of the NPAs, if we analyze them in this framework, perhaps we may come at a different conclusion in terms of what policy is required, what kind of a setup or environment is required. So I thought, because I have closely worked with many industries, I closely worked with the policymakers also, and we have seen where we went wrong. From that point of view, I thought that, if there is some reorientation in the way, you have done, a lot of work actually. But then if you reorient your, data, the findings in this framework, perhaps you'll be able to come out with better inferences and more meaningful inferences, which will be, I think, useful for the government in, a policy formulation. Now, I don't know whether there is time, but I would say that, you are talking of the secured lending versus the unsecured lending. You see, in any bank you take, obviously, the secured lending will be almost more than 85%. Okay. No bank will give unsecured lending unless it is a very highly rated company in case of corporates. Like if it is a AAA, AA rated company with good track record of 10, 15, 20 years, then only they will give unsecured lending, which is called as a balance sheet based lending we call. And in case of, retail lending, we give personal loans, which are basically unsecured. But then if you see, NPAs will not be there in these cases. Because, here you are taken basically high quality corporates who will never default. Unless there is, as you said, there are some frauds and things like that, which have happened in fact. There were AAA rated companies and the banks are given, but they turned out to be fraud at a subsequent point in time. But then if you study the NPAs in the unsecured, obviously the proportion of NPA to the total lending to this particular segment will be definitely less. Because most of the bank lending is to the secured, whether it is corporates, whether it is retail lending. Like in the retail, you have mortgage loan and all. In the corporate, whenever you give project lending or whenever you give working capital also, they will all be backed by either the collateral or the current assets or the project assets. So since, the large proportion of the lending is secured, obviously the NPA will be in that kind of a thing.
Yes.
So I think you need to have a look at this kind of interpretation, because anything we interpret will have some implication from the point of view of policy. I think I will send across my comments, although quite a few are there which I would like to have shared. But I will stop here, and maybe subsequently, if required, I will pitch in. And I will thank you again for support.
Thank you, Tada. So I think this is exactly what I expected from you, and you have delivered. As an old hand of Indian development banking, I think you have an overview in your mind, of what happened, how things shaped up. And so that is very helpful. I'm sure Santosh is taking notes. And of course, your written comments would be extremely helpful for him to revise and make it more accurate, more meaningful. So with that, let me turn to next panelist, Professor Rudra Sen Sarma of IIM Kozhikode. Over to you, Rudra.
Thank you, Professor Kumar, for the opportunity to share my thoughts. With your permission, can I share a few slides? I have just 4 or 5 slides, and I'll take 1 or 2 minutes per slide. So with an eye on the time, I'll finish it in less than 10 minutes. So first of all, congratulations to Dr. Santosh Das and ISID for successfully completing this very interesting study on a very topical issue. So in sum, it's very exhaustive study, very detailed study, and also technically rigorous. So I congratulate you, Santosh, for doing a great job. Now, let me give you some thoughts on each of the, not each chapter, because you have a lot of chapters. So I'm just picking up some 3 or 4 themes and pointing out 1 or 2 observations. So the first few chapters are about the changing landscape of banking in terms of advances, deposits, and NPAs. So I thought that one of the things we should highlight in any such discussion or study is the huge cost that NPAs inflict on the economy. So normally people think that NPAs are a problem of the banks. It will lead to losses. But as Mr. Tadas also referred to, financial repression and the larger costs for the economy in terms of lower interest earned by depositors, a fall in credit growth, and then because of recapitalization by the government, less fiscal space for developmental spending. So, and then of course, repercussions of a weak banking system for the entire financial system and the economy. So I think that's something we should talk about more often than we do, so that people know, what a big deal high NPAs are. Now, looking at the composition of NPAs, it's interesting that although overall public sector banks have a higher share in NPAs, and as Mr. Tadas was saying, it could be because of government policies, it is because of the expectations of public sector banks to lend more, but you can also identify some pockets of excellence. So within the public sector banking system, there is this Bank of Baroda, Indian Bank, Vijaya Bank, which is of course now part of Bank of Baroda, few others like I think Canara Bank, Syndicate Bank, who are showing lower NPAs as a percentage of total advances than other public sector banks. In private sector, of course, we know HDFC Bank, which is known to be a very low risk bank. So it would be very interesting to know, what do these banks do differently? I mean, HDFC Bank, we know they focus on retail lending, so it is well understood. But what does Bank of Baroda, Indian Bank, Syndicate Bank, Canara Bank do differently, so that even within public sector banks, they are able to have less NPAs than others? And one more interesting observation I found from the study is that the high NPA sectors are not necessarily sectors which are otherwise in stress. So although mining and quarrying, paper, gems and jewelry, these are contributing to the highest share of NPAs, but they are not necessarily those sectors which are under larger economic stress. So I thought that the problem therefore may not be the sectors, it could be some firms within those sectors which are the problem. And it's not entirely an external problem, but it could be business specific problem. So that was my observation on this part of your work. Now, there is this interesting econometric analysis of profits and NPAs. So in one regression, you're trying to explain profit using various indicators. In the second regression, you are explaining NPAs using various indicators. So the first interesting result is that there's a negative impact of ROA, negative impact of NPA on ROA. So higher NPA leads to lower profit. Now, that by itself is not a surprising result. As you have said, the literature has also found this result. You have been kind enough to cite my paper also on this. So I think it would be interesting if you could uncover some deeper layers of this. So this is a interesting result, but what else is happening? Is there some non-linear relation? Is there some threshold after which the relationship changes? Is the effect different before IBC, after IBC? Is it different for different banking groups? So maybe if you dig a little deeper, some more interesting results could come up. One of the interesting results, of course, which both Professor Kumar and Mr. Tadas have spoken about, is that that the secured loans are showing association with higher NPAs. So I interpreted it as that maybe because these are secured loans, so the monitoring is less, or that this could reflect weak resolution mechanisms prior to IBC. But of course, Mr. Tadas has added more reasons, so I will not go into this. You have given one reason in the report, which is a fall in asset prices could cause the security value to come down, which could result in higher NPAs for secured loans. That can actually be tested. So you simply need to interact the secured loans with asset prices in your model, and it would be an interesting result if we could find any effect of that. Now, I have a couple of suggestions. One is that it would be interesting, as I said earlier, what is Indian Bank or Bank of Baroda doing differently from other banks? So maybe if we could study some banking strategies, such as the type of loans that they give, the type of board that they have, their portfolio composition, etc., and see whether that has any effect on NPAs that could generate useful implications for policy and practice. And one last econometric issue, which I can send you details later, there is an issue with including ROA in the NPA regression. There's a potential endogeneity problem, because previously you have regressed ROA on NPA. So obviously, if you claim that NPA is driving ROA, then you cannot claim the other way around, that ROA affects NPA. So either you need to use a system regression with both equations, or just drop the ROA from the NPA regression. So that's just an econometric issue we can discuss later on. Now, last two slides. So you have talked of the credit behavior of banks across various sectors, and there's an interesting chapter on willful defaults, which I really enjoyed reading. So one comment stood out. You have said that, the one in double quotes, is that while the volume of willful default across categories of banks have increased, but the share of public sector, private sector, foreign banks have remained constant. So it appears as if willful default proportion has remained the same over time. But what I did was I took that data from your chapter 7, divided it by the advances made by each banking group, which is there in chapter 2. And if you look at the percentage of willful default as a percentage of total advances, it has increased 3 times for public sector banks, from 1% to 3%, and has actually declined for private sector banks. So clearly the problem is more serious for public sector banks than for private sector banks. Interesting finding is that across industries, you have shown that over leveraging is not there. So leverage is not a big problem, and the interest coverage ratio is adequate. So my takeaway from that is that industries do not have a problem. And this is a point I had made earlier also. Maybe these are individual businesses or maybe individual banks who are the problem, not industry at large. There is a section on IBC. My takeaway from that is that IBC seems to be a reasonable success, because your data shows that 60% of the cases have been resolved in various forms, either closed, settled, or withdrawn. So only 40% are still outstanding. After this, you have talked about various NPA management measures and you have given your recommendation. So there's an interesting comparison of different countries, which you skipped today because of lack of time. What I thought is that most of the countries from which we get this ARC idea, so, for example, Indonesia, Thailand, US, Sweden, and a few other countries, South Korea, except for China, all these countries have predominantly private sector banking system. Sweden, you said, has public sector banking system. Maybe it was there earlier in the 90s, but right now it's predominantly private sector banking system. So I am not very sure whether ARC or AMC can be a permanent solution. It could be a one-time solution to reduce NPAs, but will fundamental problems of public sector banks go away by having a one-time ARC? I'm not very sure of that. However, this Swedish model of Securum is a good model. I didn't know about it. I would encourage you to probably write a newspaper article about it. It's a very interesting example, which in India, since we are talking of bad bank now, it could be followed for the Indian case. Now, my final remarks is that fundamentally, I feel that there is a problem of corporate governance, and the corporate governance problem is in public sector banks. The problem is this, and this has been highlighted by many people, including Dr. Y.V. Reddy is fond of saying this, that the government seems to use public sector banks as development agents in the states where the union government does not have a presence. So the fundamental question, therefore, is should public sector banks function as commercial loan making and deposit taking institutions, or should they function as government grant agencies? So there's a conflict between these two functions. So in my view, if the government wants to make fiscal transfer to people, citizens, to the industry, direct transfers in terms of subsidy, in terms of tax cuts, grants seem to be a better means of transferring transferring money or support rather than doing it through public sector banks and leading to NPAs, because that has moral hazard effect of spoiling repayment culture and affecting depositors returns, etc. So that is one issue I have with the public sector bank model. So what is the solution therefore? So solution is, as you said, we need to improve governance in public sector banks. We need to ensure that public sector banks take decisions in a more commercial manner. So it's very difficult, of course, to distinguish between a bad business decision, like a loan going bad because of imprudent lending, like Mr. Tata said, or fraudulent action. So how do you distinguish? So we have cases of CBI knocking on the doors of retired bank officials, and we know that that can spoil the lending culture or make public sector officials less prone to increasing lending. So that's a big problem. So we probably need to allow public sector banks to become more commercial. One way could be to increase pay. So for example, RBI has this policy for private sector banks introduced in 2019 that 50% of the pay should be variable pay. Maybe for public sector banks, salaries can be doubled, but 50% could be made variable. So that could be one option. A few other solutions at the end. So as I said earlier, I think this ARC or a bad bank can be a temporary problem, but we need more fundamental solutions. You have given a lot of recommendations in your report. I'm adding a few. One is maybe the bank's board bureau or a bank holding company can be given the responsibility to run or manage public sector banks so that there's an arm's length distance created from the ministry. Secondly, we could allow RBI to have complete supervisory control of RBI rather than having a dual control with Ministry of Finance. Third, there's an interesting paper you have cited in the report by Meta 2019, who found that collusion between the borrower and the loan officer is correlated with higher probability of default. So I was thinking maybe technology could be a solution. Automation of loan sanction procedure could reduce the bad loan problem partly. Finally, we need alternative solutions. So it's easy for me to say that we should that public sector banks are a problem, but as Mr. Tadas said, they are the ones who are doing the heavy lifting for the economy. But perhaps we need alternatives. So we need alternatives for risk finance. Alternative could be DFIs, as Mr. Tadas has recently written a paper on, or we could have markets like corporate bond markets, which you have referred to. We can have higher equity participation by retail investors, which will move us from predominantly bank dependence to market dependence. And finally, since it's an afternoon session, I thought I'll be a little provocative and end by saying that maybe the fundamental problem, if all these are not going to solve the issue, could therefore be answered by privatization of public sector banks and thereby settle the matter of corporate governance failure once and for all. Thank you.
Thank you, Rudra. And again, very insightful comments, not only on the methodological part, but also the policy side. And I'm sure my colleague Santosh has taken notes and will incorporate as much as possible. We really benefited from your comments. And I think we have run out of time, so we need to extend this. So I seek your permission to extend this. And we still have to hear our third panelist, Professor Ananya Ghosh Dastidar. So Ananya, you have the floor. And of course, so we're running out of time, but we want to hear you very well. Yes. So over
Thank
to you.
you. The good thing about speaking at the end is you don't have much to say because the other panelists.
I'm sure you have a lot to say.
Yeah, I'm kidding. But it was very interesting and a great learning opportunity reading the report, because this is really something that I've always wondered, that as an economist, why didn't I study more about banks? I mean, the ISLM model we studied talked about the interest rate, but the banks never came into the picture until, of course, there is a crisis. So I'm going to start off from where Rudra left. I'm afraid I'm not as optimistic as you are about the future of privatization, because we've seen two sets of crises, the Asian crisis and the global financial crisis, actually spring out of lack of regulation. When, the Glass-Steagall Act was removed, and you had a very liberalized financial atmosphere within which banks got to operate, they just, even turned something which was supposed to be as safe as securitization into a kind of instrument which actually brought on this crisis. So I think, Santosh, you see, I have always seen NPA as an outcome of a problem, right? So I think you have to really place your study in perspective, because you can't do justice, you can't make everybody happy. So you have to adopt a perspective. What is the perspective with which you are tackling this problem of NPA? Okay, because as you have seen, there's so many dimensions to it. NPA is a problem for the bank, but NPAs are a problem, are merely an outcome, because they are decisions, they are the results of decisions that have been taken in the past to lend to the wrong people, which infrastructure was a great sector to lend to at one point, but then the growth stalled, and then infrastructure looked so dull today, right? So I think I would really suggest that for your policy recommendations, your analysis to be meaningful, carefully prepare the context, and you don't have to make everybody happy. That's the good thing, right? So adopt a perspective and look at the problem from there, because I'll tell you where I'm coming from. I mean, as an economist who for years taught this course called Global Finance, where we just looked at crisis, right? So I saw that the main problem of looking at this NPA problem from the perspective of an individual bank is that you miss the wood for the trees in some sense, right? Or it has said that the opposite way, because the whole thing of financial stability. Now the RBI is bringing out a financial stability report. You have umpteen case studies. The Northern Rock, for instance, the Northern Rock Bank in the UK. I mean, it just shows that one bank taking on too much NPAs and failing, even one bank, right, can spell doom for the entire sector. Because the fundamental problem of banking is it was called the TBTF, too big to fail, is that it rests on a kind of classic moral hazard, right? The banks know the governments can't let them fail. It's too costly, right? So why should they even bother to lend prudently? No government can afford to have a bank fail. If you look at Reinhardt and Rogoff, when they talk about this time it's different, right, which is a whole book on crisis, they say that, look, it's leverage. But then if you say leverage is a problem, you can't just shut the banks, right? So it's really all about regulation. So if you're going to privatize, it's really all about effective regulation. I don't know if I'm making myself clear, but what I'm saying is that, NPAs are just like the tip of the iceberg. It's really, there's a lot going on out there. Okay, so that's one of the things I thought I would mention to you. That do place yourself very carefully, that where are you coming from, and from your study it really looks like you're coming from a development industrial, a sort of bank's role as financing industrial development perspective. Stick to that, that's great. Okay, but do realize, as Mr. Tada said, that history matters. Today's NPAs are rooted in past decisions. So you really can't sort of say, I will start from 2005 to 19 because that's my perspective. I mean, whether you like it or not, those 2005 scenario was playing out from, from the past. So do bring in some of that, some limited amount of history, which Mr. Tadas, I think, made a great job of like summarizing. And Rudra also said, like, we've passed from financial repression to liberalization. That there's been these host of committees, and each of them have brought in stuff about how banks operate. Okay, so that's really my broad point. Now I had a few sort of kind of pointed things that I wanted to mention. Number one, I would really be happier to see some more data analysis, okay? In the sense, don't just stick to these line plots and bar graphs, use box plots. Nothing like box plots to tell you where is your median, okay? So for instance, you had some of these things and sectoral composition of lending to MSMEs, right? Use box plots over there to see, to bring out the comparison between private and public sector banks. Stata will do box plots. Every program will today do box plots for you. Okay, so do use them to sort of bring out some of these differences more sharply. Okay, it will also help you address the point that Rudra raised. And it'd be lovely to see some more details, right? And that's one of the points that I had in mind, and he already mentioned it. I would really like to see some case focus. Okay, so maybe a box on the infrastructure sector, because you're saying that's where the problem lies of NPAs. Right? So a box on the infrastructure sector, another one on some of the banks. I just had in mind that some of the banks are doing differently. Why not do a little case study or a focus box on one of them or a group of them as would be convenient. Okay, so that's the suggestion so far as your data analysis is concerned. And do present some details of the banks, which even Rudra mentioned. Now, the other thing is your empirical strategy. Now, look, apart from this point about endogeneity, which Rudra has already flagged, look, your model picks random effects. Now, the good thing about that is that you can now use dummies. So use box plots and split your banks into groups, right? Highly leveraged, low leveraged, and use dummies to see if you can get some mileage out of that. I have a feeling you will. Okay, so put in some dummies in your random effects regression, because you can do it. Fixed effects doesn't allow dummies, but then random effects does. And the data analysis will really reveal the story. If you, I mean, particularly as I keep saying, I mean, I love box plots. Okay, they really reveal the story. Okay, now I think you've got a great job characterizing the problem, but if you just delve a little deeper, it'll really help. And here, regarding this infrastructure point of yours, do read Mihir Rakshit. I mean, I was a little surprised not to find Rakshit on your reading list, because Mihir Rakshit has a brilliant set of papers which have been appearing in Money and Finance ICRA. Okay, particularly Rakshit's 2016. Okay, so I actually fished out the exact reading so I could tell you what it is. It's India's post-crisis macroeconomic slowdown, some perspectives, in the ICRA Bulletin, Money and Finance 2016. Okay, it's brilliant. And he also has one on, India, Keynes and the Contemporary Economic Crisis. That's also in the ICRA Bulletin. They're two beautifully written pieces insights on how this infrastructure problem really became a problem, because he highlights something which I didn't find, maybe you mentioned, but I missed it. It's the low interest rates abroad, which made the infrastructure companies really go for it. Okay, so it was PPP, loans were cheap, and they went for it, right? And once the rupee plunged, their books went bad. Okay, so this balance sheet problem, which spills over from the external sector, okay, that hit the infrastructure sector big time, and the growth slowdown just killed them, because with all this thing about fiscal consolidation, etc., the low growth has been a huge problem. So you'll be able to highlight that effectively. Okay, now just a couple of 2 or 3 more points. One, maybe I don't know whether the numbers are there, but if you could focus on the volume versus value. So there are NPAs which are small in number, so few companies but accounting for a lot, and large companies but accounting for a small amount. Okay, if that aspect could be explicit in your report, I feel it will be really good. Okay, there is such an aspect worth highlighting, because somehow I felt I missed it. Okay, in the data analysis, if that could be highlighted, are there really a few companies or a few sort of, like just in terms of the numbers and versus the values? That's one point. Secondly, you flagged a very interesting feature, which is banks reducing reliance on interest income. Now, you see, this is classic. This is Krugman's point about shadow banks. And that's exactly what so Moushumi Dash, my student Preeti, our student, Moushumi's and my student Preeti, Mendirata Arora, and we have a paper in EPW 2018. Okay, which again, I got the reference out for you. It's on my Google Scholar page. Okay, so the reference is right there. It's called Interlinkage between Credit, Housing Prices in India, Some Preliminary Findings. Sorry, that's not the one. Mortgage Loans, Risky Lending and Crisis. Yeah, so this is EPW. And I've actually worked on this also. So housing finance, what we thought doesn't matter in India at all because of the size of it, may not be something you want to ignore, because affordable housing has brought in a huge change in the way people are borrowing to build houses. And we've had these double crises, right? There's been a growth slowdown, there's been the pandemic, people are losing jobs, and they've taken loans, right? And they've not yet gone bad, but space to watch. And the banks have been doing exactly what Krugman has described in his book as shadow banking. This is a return of depression economics, right? Where he says this, that they just take these things off their books. So what you're reading on their books is not even all of the problem, perhaps. And you raise it, you see it in their reducing reliance on interest income. So you could perhaps delve a little deeper through this house price, maybe just a box on a problem that's on its way, the new kid on the block kind of thing. Okay. And yeah, I think that's it. That's yeah, the bad banks. Okay, yeah. Now you see, Rudra, I'm afraid Santosh has been beaten to his newspaper article by this gentleman called Pratik Datta. Now you must read this paper by Pratik Datta, which I ran into in the Indian Express. So I have the reference somewhere. I'll just tell you. It's in the Indian Express. And yeah, it says lessons from China on bad banks. Since 25th of June, Indian Express, bad bank lessons from China. So as Rudra was saying, so it talks about China's Huarong bank crisis. Okay, so here is a nationalized, here is a banking setup in a nationalized context, and you have a sort of bad example with a bad bank, right? So I think you should have a look. And sort of, I mean, we have lessons to learn from there, clearly. Okay, so maybe a lot of sort of different points, but there you are. That's my those are my comments, and happy to interact with you if you want to do it further at a later time, because today we are short of time. Thank you.
Thank you very much, Ananya, and I expected nothing less from you. And you have even provided number of references to Santosh to take his work further. And I'm sure he will be in touch with you individually, all three of you. So although we have run out of time, but I want to just check if anyone in our, participants wants to share something with Santosh at this stage, or you can always reach him afterwards. So just want to check if there is any burning question in anybody's mind to give to Santosh now. Otherwise, we can wrap it up, and I'm sure Santosh can talk to you bilaterally. So, is there any hand raised? If none, I think Santosh, you want to very quickly react, but all of these points I see are very well received, and I'm sure you would have benefited a lot, and they will all be very helpful for your revisions, especially when you prepare for a book out of this report. So you want to quickly react in just 1 minute or so?
Yes, sir. I think I should thank all the distinguished panelists for their comments. It's really helpful. And as you said, subsequently, when I prepare for publications and all, and also I'll try my best to revise some aspects that if I can take it off for the report that I'll do, and for my sort of publication purpose, I'll be using all those comments. Thank you so much.
I just wanted to add one thing, Santosh, very well done, because you see, I teach in a business department. So I keep seeing these kids who are doing MBA, etc., look at this problem. But it's very nice to see an economist engage with these, because I do think we have a different perspective to bring to the table. And congratulations on taking this up in the first place.
Yeah,
Very nice.
one thing, sir, maybe in 30 seconds, I wanted to say that actually my sort of entry to this problem is from a bank's point of view. So, and as Professor Rudra and Soma has mentioned, I could figure it out, the differences in NPA among the banks. Actually, there was a field study to be done to explore these aspects, to cover all the banks and all that. Because of Corona, and because my project fell into last 1.5 year basically into Corona period, so I couldn't do that survey study. So
Yeah.
that is what I was sort of wanted to sort of discuss and explore a bit further on that. So that is something the report is missing. That's true. Thank you.
Yes, no, we fully understand the constraints you faced in getting very primary kind of information from the field. And I'm sure later on, when things normalize, you will be able to draw some kind of insights from the field, which will further enrich this work. So with that, I really want to thank all the three of our panelists for joining us and giving and sharing their insights, very valuable insights to my colleague Santosh, who I'm sure will take care of many of those suggestions and all that, and produce even better work than it is. It's already, as everyone said, very solid piece of work, but there is always room for improvement. And so in that direction, I think all of these comments will be very helpful. And we will be in touch with all of you for further collaborations, because this is, the kind of work that we will continue. In particular, I am in touch with Tadas about making a very strong case for a development finance institution specialized for industrial needs. And so we will continue to work on these matters and these issues. And so with that, thank you very much once again to Santosh. Congratulations. And thank you to all our participants, especially the three experts. So with that, on that note, once again, thanks, and we will remain in touch. Bye-bye.
Thank you.
Thank you. Bye-bye.
Thank you.